This is a time of major change in tax administration. By April next, the changeover to the more equitable system of tax credits will be completed, and the process of moving the income tax year into line with the calendar year will begin. And of course, from January 2002, all taxes will be paid in euro.
Last December, the Minister for Finance announced the latest changes in an ongoing reform of the tax system. Tax-free allowances, tax tables and a tax year from April to April, these will soon be things of the past. From April 2001, the tax-free allowance system will be replaced by a tax credit system. And the tax year, like the calendar year, will start on the 1st of January and end on the 31st of December.
The first calendar tax year starts on the 1st of January 2002. It will be preceded by a short transitional tax year starting on the 6th of April 2001 and ending on the 31st of December 2001. So why these changes?
Well, firstly, they make things fairer and more equitable. With tax credits, taxpayers get the same value from tax reliefs, whether they pay tax at 20% or 42%. Both lower and higher paid employees benefit to the same extent. They also make things simpler. Employers will still deduct PAYE on behalf of their employees, but the way it's calculated will be different and, as we'll see later, more streamlined. Having the tax year and the calendar year coincide makes sense. This CD-ROM is designed to help you understand and operate the new tax system. Making the change will be easier than you think.
From the 6th of April 2001, tax-free allowances and tax tables will be replaced by tax credits and the standard rate cut-off point. The standard rate cut-off point is the level up to which an employee pays a standard 20% rate of tax. All earnings over this are taxed at 42%. The standard rate cut-off point is calculated by the tax office and can vary from person to person depending on their individual circumstances. Mary is a single PAYE worker with a gross monthly salary of £2,500. Her standard rate cut-off point, which is calculated by the tax office, is £1,644.45 per month. This means that the first £1,644.45 of her monthly salary is taxed at 20%. Everything she earns over this is taxed at 42%. The sum of these two figures is her gross monthly tax, £688.22. Mary's colleague Martin earns the same monthly pay as Mary but is married, so his monthly standard rate cut-off point is £2,384.45. Gross monthly tax, £525.42. All employees are taxed on their gross pay. This gross tax is then reduced to give the final tax payable. The actual amount of tax each employee pays is their gross tax minus their tax credit. Like the standard rate cut-off point, tax credits are calculated by the tax office and are based on each employee's personal circumstances. As a single PAYE worker, Mary's monthly tax credit is £123.34. This figure, subtracted from her gross monthly tax, gives the actual tax Mary pays. Again, the tax credit can vary depending on an individual's personal circumstances. Martin, for example, who's married, gets a tax credit of £213.78 per month. Because the system is fully streamlined, things like benefit in kind, non-PAYE income, mortgage interest relief, and allowable employment expenses are all incorporated into an individual's tax credit and standard rate cut-off point. This is all worked out by the tax office and listed on each employee's tax notice. The employee gets a full breakdown like this. Only the bottom line figures, the total, monthly and weekly tax credits and standard rate cut-off point, are issued to the employer. Later, we'll see how the actual calculations work in practice. Tax-free allowances and tax tables will be replaced by tax credits and a standard rate cut-off point. Tax credits are calculated by the tax office and are based on each employee's personal circumstances. The standard rate cut-off point is calculated by the tax office and can vary from person to person depending on their individual circumstances. The standard rate cut-off point is the level up to which an employee pays the standard 20% rate of tax. All earnings over this are taxed at 42%.
So what will the new forms look like? Well, as before, each employee's tax details will be supplied to you by the tax office in the form of employer certificates or tax deduction cards. The details they contain, however, will be different.
This is what the new tax deduction card will look like, similar to the old one, but with the extra features needed to operate the new tax system. Employers who operate a manual system will receive a tax deduction card for each employee, pre-printed with standard rate cut-off point and tax credits for each pay period. Detailed information on the completion of the tax deduction card is set out in the PAYE Notice to Employers publication. Employers who do not use tax deduction cards will receive this, a certificate of tax credits and standard rate cut-off point for each employee. This replaces the old certificate of tax-free allowances.
If you operate a computerised payroll system and are part of the Computer Media Exchange Scheme, you'll receive the relevant information in electronic format prior to the 6th of April 2001 and in paper format after that date.
Each employee's tax details will be supplied to you by the tax office in the form of employer certificates or tax deduction cards.
So how will the new system affect the way you do your job? Whatever system you operate, the certificates of tax credits and standard rate cut-off point and tax deduction cards contain all the information you need to calculate an employee's tax. The actual calculation for each pay period involves just 2 simple steps.
Step 1. Calculate the gross tax. For this, you need 2 figures, the employee's gross pay and the standard rate cut-off point, which applies to that pay period. Everything up to the standard rate cut-off point is taxed at 20%. Everything above that point is taxed at 42%. Gross tax is the sum of these 2 figures. Step 2. From the gross tax, subtract the tax credit, which applies to that pay period. In Mary's case, her monthly tax credit of £123.34 is subtracted from her gross monthly tax of £688.22 to give the tax she actually pays, £564.88. Likewise, Martin's monthly tax credit of £213.78, subtracted from his gross monthly tax of £525.42, gives his tax payable, £311.64.
And that's it, a simple formula. Gross tax minus tax credit equals tax payable. Like tax-free allowances, tax credits in themselves are not refundable. Any tax credits not used in a pay period carry forward to the next pay period. Here's an example. When the gross tax in a pay period is, say, £100 and the tax credit is £120, the employee has no tax to pay for that period. There's no refund. Instead, the unused tax credit of £20 is carried forward and offset against tax due in the next pay period. The same applies when an employee's pay is less than their standard rate cut-off point. The unused amount of the standard rate cut-off point is carried forward to the next pay period. A tax refund can, of course, arise when the tax actually deducted to date is more than the tax actually due to date. In cases where you haven't been advised of an employee's tax credit and standard rate cut-off point, emergency tax will apply. More detailed information on this and other issues, along with worked examples, can be found in Revenue's PAYE Notice to Employers publication.
The actual calculation for each pay period involves just 2 simple steps. Step 1. Calculate the gross tax. Step 2. From the gross tax, subtract the tax credit. Gross tax minus tax credit equals tax payable.
So when does the new PAYE system come into operation? In February and March of 2001, the Revenue Commissioners issued employers with a tax deduction card or certificate of tax credits and standard rate cut-off point for each employee.
On the 6th of April 2001, the system goes live. On the 1st of January 2002, the tax year will be permanently brought into line with the calendar year. This also coincides with the final changeover to the euro. To make way for the change to the new calendar tax year, there will be a short transitional tax year from the 6th of April to the 31st of December 2001.
The Tax Office will make all the necessary adjustments to take account of this one-off short tax year. They'll do this simply by dividing the total tax credits and standard rate cut-off point by 38 for weekly paid employees and by 9 for those paid monthly. You simply calculate tax for each pay period using the figures supplied to you.
From April 2001, the tax-free allowance system will be replaced by a tax credit system. The first calendar tax year starts on the 1st of January 2002. This also coincides with the final changeover to the euro. There will be a short transitional tax year from the 6th of April to the 31st of December 2001.
As your company's main point of contact with the new tax system, you'll probably be asked plenty of questions over the coming months. Relax. Let's review the main points of this presentation and look at a few of the questions you'll most likely be asked.
So how's my tax worked out with this new system?
The calculation is straightforward. Your gross pay is taxed at the appropriate rates to give your gross tax for each pay period. This gross tax is then reduced by the value of your tax credit to give the actual tax you'll pay. Gross tax minus tax credit equals tax payable.
So what rate of tax am I paying now? Is it 20% or 42%?
For each pay period, weekly, fortnightly or monthly, the money you earn up to your standard rate cut-off point is taxed at 20%. Everything over that is taxed at 42%. The tax credit and standard rate cut-off point are calculated by the Tax Office and can vary depending on each individual's personal circumstances.
How come my total tax credits and standard rate cut-off point are divided by 38 and not 52?
Because the 38 weeks between the 6th of April 2001 and the 31st of December 2001 make up a one-off short tax year. From then on, every tax year will have 52 weeks, from the 1st of January to the 31st of December. This short tax year is needed to bridge the 9-month gap between the old April to April tax year and the new calendar tax year, which starts on the 1st of January 2002. We hope that this presentation has helped you make sense of the new tax system and how it affects the way you do your job. Soon, the new system will be as familiar to every employer and employee as the old. The Revenue Commissioners are committed to helping you make the change to the new tax system as easily as possible. This CD-ROM, which is also available in video format, is just one part of that commitment. Whatever questions you may have, we'll supply the answers.
You'll find more information on the PAYE Tax Credit System in Revenue's comprehensive publication, PAYE Notice to Employers, which was issued in February 2001. You can get additional copies of this publication by calling Revenue Forms and Leaflet Service at 01 878 0100. Information is also available on the web at www.revenue.ie.
For further assistance, contact your tax office.